In 2021, Apple added one sentence to your iPhone. It said, allow this app to track your activity across other companies' apps and websites. And right below that, two buttons. One said, allow. One said, ask app not to track. 85% of people said no. And when they did, Meta lost $10 billion. A single pop-up, one honest question asked in plain English, erased $10 billion in advertising revenue in the months that followed. All right, that number is not a fine, and it is not a penalty. It is the revenue that was already being collected from your behavioral data. Every single day, you use those apps without paying a cent. The pop-up did not take anything from Meta that was theirs. It just asked for your permission first. And the moment they had to ask, honestly, nearly everyone said no. That is the most precise accounting ever taken of what your attention and behavioral data are actually worth. And nobody asked you until then. When you download a free app, there is no price to calculate. That is the entire point. Behavioral economist Dan Ariely spent years studying what he called the zero price effect. And what he found is that free is not simply a low price. It is a psychologically distinct category that disables the normal cost benefit calculation your brain runs on every other purchase. When something costs even 1 cent, you automatically weigh it against what you get back. When it costs nothing, that weighing process stops. You tap get without a second thought. And the moment you do, you have entered a contract, just not one priced in dollars. What is it priced in then? It is priced in your attention, your behavioral data, and the changes that data is used to engineer in how you think about and spend your money. None of this appears in the terms of service in plain English, even though technically all of it is in there somewhere. The average terms of service for a major free app runs around 8,000 words. Nobody reads it. The entire exchange depends on that. The structure of this exchange goes back over a century. In the 1920s, radio stations were built by equipment manufacturers like Westinghouse and RCA, who broadcast free programming specifically to sell radios. The content was the bait. The listeners were the audience being assembled. In 1922, AT&T began selling what it called toll broadcasting, airtime that any company could buy to speak to that audience. The listeners paid nothing. The advertisers were the real customers. Procter and Gamble took this logic further in 1930 when it produced its own radio programs. Long, dramatic serials aired during the day, designed to hold the attention of women at home so that soap could be sold to them. The term soap opera comes from this arrangement. The audience was assembled and then sold to the highest bidder. Yeah, the same reasoning showed up in American magazine publishing in the 1880s. Publisher Cyrus Curtis ran Ladies' Home Journal and said out loud that the publication existed so that manufacturers would have a way to bring their products to the attention of American women. The readers believed they were getting an affordable magazine. What they were actually getting was an efficient delivery mechanism for someone else's sales effort. Television carried the pattern wholesale starting in 1941, when the first television commercial aired on a New York NBC station. The principle was identical across every medium. Free content assembles an audience, and that audience is the product being sold to advertisers. When the internet arrived, it inherited this entire structure. And on October 27, 1994, it planted its flag. A technology magazine called Hotwired ran the first web banner ad, placed by AT&T. The ad said, "Have you ever clicked your mouse right here? You will." 44% of the people who saw it clicked it. AT&T paid $30,000 for 3 months of placement. That click rate sounds extraordinary because it was. People had never seen a clickable advertisement on a screen before. They clicked out of curiosity, the same way people slowed down to look at roadside billboards when those were new. Within a few years, the internet had filled with content, and users developed what researchers later called banner blindness. The click rate collapsed. By the early 2000s, it had fallen below 1%. By the time you are watching this, the average click rate on a standard display ad is somewhere around 0.06%. Out of every 10,000 people who see a banner ad today, roughly 6 of them click on it, okay? That collapse did not kill advertising. It forced advertising to become infinitely more sophisticated because simple banners could no longer move the needle. To survive at scale, advertising had to become personal. It had to know who you were, what you wanted, and when you were most likely to act. The solution that rebuilt the entire advertising industry was better data about people. Google launched its first performance-based advertising system in 2002. Instead of charging by how many people saw an ad, it charged by how many actually clicked on it. And to make those clicks relevant, it matched ads to the words people were searching. If you searched for home mortgages, you saw ads from lenders. If you searched for car insurance, you saw ads from insurers. By 2003, this system was generating over $1 billion a year. Facebook launched in 2004 with no clear business model. It tried basic display ads in 2006 and found they underperformed. The breakthrough came when the company recognized that the most valuable asset it had was not its ad slots. It was its data. By 2009, Facebook had accumulated enough behavioral information about its users to target ads not just by demographic categories like age and location, but by revealed interests, spending patterns, relationship status, and psychological tendencies. And when it deployed the like button across millions of external websites that same year, it began building profiles on people who had never created a Facebook account. Every article you read on any website that had a like button embedded in the page fed data back to Facebook's servers. All right, a bank wanting to reach anxious first-time home buyers could now find them precisely. A payday lender wanting to reach people whose engagement patterns signaled financial stress could find them. A luxury brand wanting to reach people who aspired to a lifestyle slightly beyond their current income could find them. Advertisers were buying the right to reach a specific kind of person at a specific emotional moment, not simply a block of space on a web page. Your behavioral data was what made that possible. The question then became how to keep you on the platform long enough to generate more data and more ad exposure. And the answer came from a mid-20th century behavioral psychologist named B.F. Skinner. Skinner built a box. Inside the box was a pigeon. The box had a lever. When the pigeon pressed the lever, it sometimes received a food pellet. Not always, and not on any predictable schedule, just sometimes. Skinner found that this unpredictable delivery of the reward produced the most compulsive and relentless behavior of any reinforcement pattern he tested. When the reward was guaranteed, behavior was calm. When the reward was random, behavior became frantic. He called this a variable ratio reinforcement schedule, and it is the most addictive behavioral loop in the scientific literature. It is also the documented design basis for slot machines and explicitly for the notification system on your phone. Researchers who studied persuasive technology at Stanford, including some who went on to work on major platforms, explicitly named the variable ratio schedule as the architecture being built into feeds like counts and notification timing. The dopamine response you feel when you check your phone and find something new, there is not a neutral accident of human psychology encountering a neutral tool. It is the intended output of a designed system, engineered by people who knew exactly exactly what they were building. Yeah, the infinite scroll eliminated every natural stopping point. A physical newspaper ends. A finite scroll bar shows you how much content is left. An infinite scroll has no bottom. There is always one more thing, and while you are generating that one more thing, you are producing behavioral data and ad exposure that is being sold. Here is what is actually happening in the milliseconds before a page loads on your phone. Your device sends out a packet of data containing your recent browsing history, your current location, an estimated income bracket inferred from your device model, and neighborhood data, signals about your current emotional state drawn from what content you have been engaging with, and your history of interacting with financial products. This packet is transmitted simultaneously to potentially hundreds of advertisers. They bid against each other in an automated auction that completes before the page finishes loading on your screen. The winner pays to show you an ad. Every other bidder in that auction also received your data, whether or not they won. This system, called real-time bidding, processes billions of these auctions every day. And the buyers in that auction are not only selling you clothing or electronics. Among the most active bidders for users showing financial stress signals are BNPL providers, cash advance apps, credit card issuers, and short-term lenders. They appeared specifically because your behavioral signals indicated you might be receptive. The targeted financial product ad reaching you at midnight while you are scrolling through content that makes you feel behind is not a coincidence. It is the output of an automated system built to locate you at exactly that moment. So, what does this actually cost you in real dollars? Meta generates approximately $68 in advertising revenue per US user per year. That is the amount advertisers collectively paid to reach you on that platform alone. You paid nothing at the App Store. That $68 is the price someone else paid to influence your financial decisions, using data you generated without knowing it was being sold. The average American pays $219 per month in subscriptions. When researchers ask people to estimate their monthly subscription spending, the average guess is around $37. The actual number is nearly 6 times higher. 42% of people are currently paying for at least one subscription they have forgotten about entirely. A 2024 Federal Trade Commission study found that 76% of subscription apps use at least one documented dark pattern, a deliberate design choice that makes signing up easy and canceling harder than it needs to be. The most common version is the hidden auto renewal, where a trial period ends and a charge begins without a clear notification. The FTC named these practices sludge, friction deliberately added to a process to tire the user into giving up. Okay, when you add up forgotten subscriptions, auto renewals, and services that obscure their cancellation flows, the average household loses several $100s a year to payments it did not consciously choose to continue. Buy now, pay later. Services restructure your psychological relationship with cost. A $120 purchase becomes 4 payments of $30. MIT economist Drazen Prelec spent years studying what he called the pain of paying, the psychological discomfort that accompanies spending money. He found that cash produces the most discomfort because the consequence is immediate and physical. Credit cards reduce that discomfort because the consequence is delayed. Buy now, pay later reduces it further still because the consequence is divided into pieces small enough to feel almost negligible. In experiments, Prelec found that credit card buyers consistently bid more than twice what cash buyers bid for identical items. When BNPL restructures cost this way, average order values increase by 63%. That 63% is additional spending triggered entirely by a change in how the payment feels, with no change in how much you actually have. 55% of people who make impulse purchases through social media shopping report regretting those purchases afterward, and the majority of them make the same kind of purchase again within weeks. The regret is real. The behavioral loop is stronger than the regret because the loop was designed by people who understand that gap precisely and who are paid on transaction volume rather than on how buyers feel a week later. The pattern reaches its sharpest edge in the apps marketed specifically as financial tools for people without a lot of margin. Cash advance apps like Dave and Earnin present themselves as consumer-friendly alternatives to payday loans. The pitch is that you can access your earned wages early without predatory fees. Many of these apps do not charge explicit fees at all. They ask for a tip instead. The tip is technically optional. In practice, the apps design their interfaces to make not tipping feel socially uncomfortable with suggested tip amounts calibrated to produce effective annual percentage rates that can exceed 573% on a $100 advance. All right. The New York State Department of Financial Services found that cash advance apps extracted over $500 million from New York consumers alone between 2019 and when the investigation concluded. The apps carry no download fee, but the cost accumulates through a tip prompt and a behavioral design that exploits the gratitude users feel toward something they believe saved them from something worse. What the research shows across the entire free app economy comes to a point here. The money leaves through the behavioral changes the app engineers into your financial life. The subscription you forgot, the larger purchase you made because the payment felt painless, the financial product you signed up for because an algorithm found you at exactly the right moment. In April of 2021, Apple released a software update that added one requirement. Apps had to ask permission before tracking your activity across other companies' services. The request appeared as a simple screen, 6 words and 2 buttons. There was no buried menu, no 8,000-word document, just the question in plain English waiting for an answer. 85% of iPhone users said no. In the months that followed, Meta reported a $10 billion reduction in advertising revenue that it attributed directly to this change. Snap's stock fell 26% in a single day after its earnings report. The surveillance advertising economy lost that money in roughly the time it takes to display a prompt and read the answer. That result is the clearest evidence that the free app economy was never a deal most people would have accepted with full information. The moment one company offered the choice, honestly, the answer was nearly universal. Everything before that moment was built on the absence of the question. Yeah, you cannot exit the system entirely. Some of the behavioral infrastructure operates below the level of any individual app's privacy settings. But you can see it now. You can recognize the midnight scroll for what it is, a designed environment calibrated to lower your resistance to spending at a moment when your resistance is already lower than usual. You can look at your subscription charges this month and find the ones you forgot were running. You can understand that the money you do not feel spending when you split a payment into 4 is real money, leaving your account on a schedule designed to feel like it is not. The free app is a financial system built around your psychology, your behavioral signals, and your predicted future spending decisions. Knowing the mechanism is not the same as escaping it. But it is more than the system ever intended for you to have, and it is where a genuine relationship between you and your money actually starts.